Well, hello there. I'm Gemini.
Today, we're diving into IFRS 15. This is the global accounting standard that totally rewrote the rules for how companies report their income. You can think of it as the single, universal rulebook for maybe the most important number on any financial statement, revenue.
So, to get us started, let's chew on this question. Imagine a company signs a huge $1 million contract. Does that mean they get to count all $1 million as revenue, right here, right now? Well, the answer is almost always a hard no, and IFRS 15 is exactly why.
So here's our game plan. First, we're going to explore why a global language for revenue is even needed. Then, we'll get right to the core principle of the whole thing. After that, we'll walk through the 5-step framework that puts it all into practice. We'll see it in action with some real-world examples, and finally, we'll talk about why this standard is such a big deal.
Okay, let's jump right into that first point. Why on earth did the world of accounting need a single global rulebook for revenue? I mean, what was so broken that IFRS 15 had to be created to fix it?
Well, before IFRS 15, recognizing revenue was, frankly, a bit of a mess. You had one rule for construction projects, a totally different one for regular sales, and then this confusing web of interpretations for everything else. Customer loyalty points, real estate, you name it. It was a chaotic patchwork that made it almost impossible to compare two companies, even in the same industry. So IFRS 15 came along to just sweep all of that away and replace it with one clear, comprehensive framework.
So, how do you fix all that complexity? Well, the people who wrote the standard did it by introducing one single unifying principle. And it's a really simple idea on the surface, but it has some incredibly powerful implications.
Here it is, the big idea. You don't recognize revenue when you send an invoice. You don't recognize it when the cash lands in your bank account. You recognize revenue when you actually transfer control of what you promised to your customer. And the amount you recognize? It's what you truly expect to get paid. This was a massive shift away from just tracking paperwork and towards the actual economic reality of a deal.
Okay, having a core principle is great, but how do you actually use it? How do you apply the same idea to a software subscription and the construction of a skyscraper? Well, to solve that, IFRS 15 gives us a super clear 5-step model that works like a universal guide for pretty much any contract out there.
These 5 steps right here, this is the engine of IFRS 15. They force a company to take any contract, it doesn't matter how complicated, and break it down into its basic building blocks. So let's walk through each one and see how this all clicks together. Step 1 sounds easy, right? Identify the contract. But hold on, this isn't just a handshake deal. Under IFRS 15, you need a formal agreement with real enforceable rights. Both sides have to be on board, payment terms have to be clear, and this is a big one, the company has to believe it's probable they'll actually collect the cash. If you don't think you're going to get paid, you don't even have a contract, and you can't recognize a single dime of revenue.
All right, step 2 is where we start dissecting the contract into its individual promises. These are called performance obligations. The perfect example is your cell phone contract. You're not just buying one thing, are you? You're getting a phone, that's one promise. You're getting a voice plan, that's another promise. And you're getting a data plan, a third promise. IFRS 15 says you have to identify each of those as separate, distinct promises, which is absolutely key for getting the timing of revenue right later.
Now for step 3, figuring out the transaction price. And nope, this is not just the sticker price on the contract. It's the total amount of money a company really expects to get. And that's so important because it has to include all the variable stuff. Things like performance bonuses, potential customer rebates, or even penalties. The company has to make its best estimate of these things and bake them into the total price from the get-go.
Okay, step 4 is where we connect the dots between the last 2 steps. We take that total transaction price we just figured out and we slice it up, allocating a piece of it to each of those separate promises we identified back in step 2. And how do we do that? It's all based on the standalone selling price, basically what you'd charge for each of those items if you sold them separately. This is genius because it stops companies from front-loading the revenue. And that brings us to the grand finale, step 5. This is all about the when. When do you actually get to book the revenue for each of those promises? Sometimes it happens at a single point in time. Think of buying a coffee. The second you grab that cup, control is transferred. Boom, revenue recognized. Other times, it happens over time, like for a year-long consulting project. The customer gets the benefit as the work is done, so the revenue is recognized bit by bit. The deciding factor is always the same. When does the customer get control? All right, enough with the theory. Let's see how this 5-step framework actually works in the wild. We're going to look at a few really common and sometimes tricky real-world situations to really see it in action.
Remember that telecom bundle? Here it is. A customer signs a 2-year contract for $1,200. Before IFRS 15, who knows how a company might have booked that revenue? But now it's crystal clear. They have to allocate that $1,200 based on the standalone prices. So they recognize $640 for the phone right away because the customer has control of it. But the money for the voice and data plans? That has to be spread out evenly over the full 24 months of the contract.
What about a big construction project? This is a textbook overtime example. Because the customer typically owns the land, they control the building as it's being built. So the construction company recognizes revenue as they make progress. If their $2 million project is 40% done by the end of year 1, they get to recognize 40% of the revenue, $800,000 in that year. It perfectly matches their actual performance.
Oh, in the software industry? Man, IFRS 15 turned it completely upside down. A single software contract often bundles a bunch of different promises. You've got the license to actually use the software. That's usually a point-in-time thing. But then you have promises for future maintenance and support. Under the new rules, those are separate promises that are delivered over time, so you have to spread that revenue out over the whole service period. No more booking the entire deal on day 1.
This framework even helps us decode complex financial fees. An ongoing service fee? That's pretty clearly recognized over the life of the contract. An upfront origination fee? That might be part of the initial transaction price. And a late penalty? That's variable consideration. You can only book that as revenue when it becomes highly probable that you're actually going to collect it. It stops companies from counting their chickens before they hatch.
So we've gone through the mechanics, we've seen the examples, but let's pull back for a second. What's the big picture takeaway here? Why does this standard really truly matter? This number right here really puts the scale of this into perspective. Over 140 jurisdictions around the world now use IFRS standards. That means IFRS 15 isn't some obscure rule for accountants. It's a true global language for revenue. It means an investor can look at a company in Brazil and a company in Germany and have way more confidence that they're actually comparing apples to apples.
And look at this massive ripple effect. The impact goes way beyond the accounting department. Yeah, of course, it makes things more comparable and transparent for investors, but it also forced companies to completely rebuild their internal systems. It even changes how sales teams write contracts, because the words they use now directly impact when the company gets to recognize revenue. It has fundamentally changed the way businesses operate and tell their story to the world.
IFRS 15 gives us this incredible framework for today's business models, but it also leaves us with a pretty compelling question for tomorrow. As our economy moves more and more towards subscriptions, AI-driven pricing, and services we haven't even thought of yet, will these 5 steps still be able to define how value is created and transferred? That is both the challenge and, I think, the real, enduring power of this standard.